Hello and welcome to week 6. It's hard to believe week 6 is already upon us. I want to congratulate those of you who have made it this far. I know it can be a challenging course because it's been the first time you've been exposed to the ideas and concepts contained in this course. And when you do further accounting and finance courses, you're just building upon this language that you already started to understand in this course. So that can make this course a little bit more challenging at times. I wanted to quickly remark upon two things in last week's discussion post in a positive way. First, I saw a considerable understanding of the idea of discounted notes and bonds. In fact, many of you were doing calculations, and the idea of discounted notes and bonds might not be as intuitive as the regular interest-bearing debt that we're more familiar with, where interest payments are made on a periodic basis over the course of time. And so that was really good. And also, I saw an understanding of the idea of how debt can be an appropriate source of financing at times. Oftentimes, when we first start thinking about debt, we have a negative connotation of it in our minds. But, we've learned that it can be a very appropriate and legitimate source of funding. And I think many of you came to see that. Certainly, there are times where it can be abused, used inappropriately, and used excessively, but nevertheless, it's appropriate at times. Okay, let's move ahead to one of the topics that I wanted to discuss and focus on this week, the statement of cash flows. You've heard me talk a lot about the importance of a statement of cash flows in the past. One of the reasons why I like the statement of cash flows because it's my contention that it's harder to manipulate than the income statement. It's not trying to be too critical or wanting to make you cynical regarding the income statement. The income statement is a critical and necessary statement, but there are some things that can be done at times to make it look a little bit better than it should. This could be by accelerating revenues, by recognizing revenues in the present that should be recognized over the course of time in the future. It could be by capitalizing expenditures that should be expensed. Obviously, when you're purchasing a building, that's an expenditure that should be capitalized, but there are certain expenditures, as you well know, that should be expensed. And when you capitalize those expenses, they're not showing up as expenses on the income statement, so the income statement is going to look better than it otherwise should. Another one is, and you don't have to understand what this entails, Enron hid some of their losses on what are called off-balance sheet entities. They were partly aided in doing this by a corrupt auditor, or at least a portion, some of the offices of this auditor were corrupt, Arthur Andersen, and they actually crumbled when it came to light what they did in assisting Enron, and rightfully so. Also, a law was passed called Sarbanes-Oxley. Many of you may have heard of it. It required or it imposed strict disclosure requirements on public companies, and it required also that the CEO and the CFO sign off on their financial statements that they produce to the SEC and investors, or face considerable liabilities if there are frauds perpetuated in those financial statements. So some of those things should keep these abuses in check. And so I want to say that so you're not overly cynical. And this also creates confidence in the public markets, which is really important both for investors and for the entire economy at large. Now, this isn't to say there aren't things that can be done to the statement of cash flows to fudge it and make it look a little bit better than it should, such as by depleting inventory, increasing accounts payable. However, a lot of these maneuvers are fairly apparent to the seasoned security analyst combing over the company's financial statements. In turn, that security analysis by the banks, by the research firms, by the buy-side firms results in a fair evaluation of the company and thus a more efficient allocation of capital across the economy. You might often hear a person on Main Street criticizing Wall Street as if they don't do anything good for Main Street, but I can assure you that Main Street benefits enormously from Wall Street in creating liquid and relatively efficient capital markets. These big corporations that employ hundreds of thousands of people wouldn't have access to the funding that they need to expand and even pursue their existing needs without being able to tap the capital markets, and without those capital markets being Wall Street, and without competent and capable advisors guiding them and even executing these transactions, and those advisors being the investment banks. Even government, which needs the funding, has to tap the capital markets, and they also use these Wall Street firms in the Wall Street capital markets as well to obtain that financing and the funding that they need. But getting back to the point in hand, if a company is consistently generating a lot of income, it's nice to confirm the company's health by, again, looking back to the statement of cash flows. Are they generating consistent, healthy cash flows and the cash flow from operations? Remember, the statement of cash flow is broken into three parts. You have the cash flow from operating activities, you have the cash flow from investing activities, and you have the cash flow from financing activities. When you add up the cash inflows and outflows from each of these different activities, it should equal the net cash increase during the course of the year. So when you take the year-ending cash balance and you subtract from that amount the year beginning cash balance, that should be equal to the sum of the cash flow from operating activities, from investing activities, and from financing activities. Now, the cash flows from operations shows us the cash generated by a company's core business operations. We're looking right here at a statement of cash flow from John Deere, and the cash flows from operating activities for John Deere would be generated by three different business units. It would be by one, selling equipment through their agricultural unit, two, selling equipment through their construction and forestry unit, and three, cash flows generated from their financial services unit. Now, the cash flows generated from the financial services unit is helpful in two different ways. One, it's generating cash similar to a way that a bank generates cash, but it also helps customers purchasing their equipment in the agricultural unit and the construction and forestry unit obtain the financing they need to make those purchases. So that's helpful in multiple ways. The other parts of the statement of cash flows right here are also quite critical, but it's the cash flows from operations, in my opinion, what separates the strong from the weak, and that needs to be robust in order for the company to be viable in the long run. If a company doesn't generate cash from operations, there will be few investors willing to provide it cash, and that's where cash generated from financing activities is recognized in this lower level. So few people are going to want to invest in the company if it's not a strong operating company. And if it's not generating cash from financing activities or operating activities, it's not going to have cash to invest. And this is recognized here in the cash flow from investing activities. And if it's not able to invest in the long run, it's not going to be able to have the property, plant, and equipment necessary to help it generate cash flow from operations, which is just going to kind of feed on itself. And then the company will deteriorate even further, and it will go the way of Sears, which is at present preparing for bankruptcy. Now, the cash flow from investing section of the cash flow statement will certainly show how much cash was invested into property, plant, and equipment and other assets to further the business's operations and generate more cash in the future. Also, if the company has to sell or dispose of equipment or other assets, it will reflect the cash received from those sales as an inflow in the cash from investing section. For a company just to maintain its current level of performance, if you think about it, without even growing or expanding, it will have to invest in the company into the business amount equal to or roughly equal to the amount of depreciation recognized on the company's income statement. In other words, assets are wearing out, so there has to be some basic maintenance capital expenditures or some basic maintenance investing just to keep the company's equipment and other assets in as good a shape now as they were in the past. So it has to replace the assets that are currently being worn out. This is the difference between growth capital expenditures and maintenance capital expenditures, and oftentimes financial analyst recognizes on the financial statements when they're trying to determine free cash flows, which is an important metric that you might learn about in future courses. And the cash flows from financing activities allows the companies to get the cash it needs to perform its operations, and which could be necessary for investing in working capital or property, plant, and equipment, or paying back investors. It shows the cash inflows and outflows from these financing activities, and it's shown on this financial model here. But if we're looking also at John Deere's, for example, talking about increases and decreases in short-term borrowings because they're constantly accessing new short-term borrowings, but they're also paying back lenders who have lended cash in the short term. So you look at all the details here: cash flows, proceeds from long-term borrowings, issuance of common stock, repurchasing common stock. They need to repurchase common stock for multiple reasons, to provide it for executives for compensation, talk about dividends paid, all sorts of different complex financial transactions that are done here, and they are reflected in the cash flows from financing activities. So just to summarize, when you add up the cash flows from the operating activities, the investing activities, and the financing activities, they equal, as you might expect, the net cash flows provided to the company, and is shown as in the difference between the year ending cash balance and the year beginning cash balance. Now, I hope this introduction was helpful to you. Really shortly, I'm going to be sending out some videos from Wall Street Prep that break down and give you some concrete advice and how to look at and build a cash flow statement. I think you'll find them very helpful, insightful, and even interesting. So I will be sending those out. Be looking out for them. I hope they are helpful to you. Good luck this next week. Congratulations on making it this far. And if you have any questions, please feel free to reach out to me. We'll talk to you soon. All right. Bye.